Tariff wars are like trade disputes. Countries impose taxes on goods from other nations. This action aims to protect domestic industries and jobs. However, tariff wars have consequences. They can disrupt the global flow of goods and services. This disruption hurts businesses and economies worldwide. The current global landscape is tense. Trade tensions are rising between major economies. This situation creates uncertainty in the global market. Businesses and investors are wary. They are unsure about the future of international trade. The impact of tariff wars is widespread. Countries dependent on exports suffer. Their goods become more expensive in foreign markets. This situation can lead to a decline in demand and economic slowdown. Moreover, tariff wars can fuel inflation. Tariff wars have a direct impact on consumers. When countries impose tariffs on imported goods, the cost of those goods increases. Businesses then pass these increased costs on to consumers in the form of higher prices. This phenomenon is known as imported inflation. Essential goods like food and clothing are often subject to tariffs. As a result, tariff wars can disproportionately affect low-income households. These households spend a larger portion of their income on essential goods. Rising prices can erode their purchasing power and lower their standard of living. The electronics and automotive sectors are particularly vulnerable to tariff wars. These industries rely heavily on global supply chains. Components are often sourced from multiple countries. Tariffs disrupt these supply chains, leading to higher production costs. Tariff wars are forcing businesses to rethink their supply chains. Companies that rely heavily on imports from countries affected by tariffs are seeking alternative sources. This shift aims to mitigate the impact of higher costs. The process of realigning supply chains is complex and time-consuming. It involves identifying new suppliers, negotiating contracts, and establishing logistics networks. This disruption can lead to temporary shortages and delays in the production process. However, in the long run, tariff wars could lead to a more diversified and resilient global supply chain. Businesses may become less reliant on single suppliers or countries. This shift could reduce their vulnerability to future trade disputes. Tariff wars introduce volatility into the market. Stock prices fluctuate more rapidly and unpredictably. Investors become more risk-averse. They tend to move their money to safer assets, such as government bonds. In this environment, diversification is crucial. Investors should spread their investments across different asset classes, sectors, and geographic regions. This strategy helps mitigate losses if one area of the market underperforms. Focusing on domestic and localized industries can be a good strategy during tariff wars. These businesses are less exposed to global trade tensions. They may benefit from increased demand for domestically produced goods. Inflation hedges are investments that protect against the erosion of purchasing power due to rising prices. Examples include real estate, commodities, and inflation-protected securities. These assets tend to perform well during periods of high inflation. Staying informed about global economic developments is crucial during times of uncertainty. Investors should monitor trade negotiations, tariff announcements, and economic data releases. This information will help them make informed investment decisions.